excited to welcome you to our final Northwoods Financial Series session of the year. Park City Credit Union has been hosting these free educational sessions throughout the year, and we look forward to bringing you more education in the new year. My name is Sarah Sturm, and I'm a member of the marketing team here at Park City Credit Union, and I will be your moderator for today. I'm excited to introduce you to our presenter, Steve Metz. Steve has been a practicing certified public accountant since 1989 and has spent his entire career in public accounting. He graduated from UW-Whitewater and started his career at a regional firm. Steve started at Anderson Metz Ltd. in 2003 and is currently managing partner of the Peterson Metz Ltd. Servicing tax clients has been a mainstay with specialized work in financial planning, financing, succession, and consulting businesses. Steve has extensive experience with nonprofit formation, compliance, and taxation. Steve is also a PCCU board member and likes being able to apply his knowledge and financial experiences to continue the success and professionalism of the history of Park City Credit Union, and we are very happy to have him a part of our team for that. So, stop sharing my screen here. Before I jump to any of the questions, I obviously want to give Steve some time here to talk about some things. And again, if he doesn't answer your questions, we have some time at the end. He will allow for questions. And again, we'll be sharing any contact information as well. So if you have any questions afterwards, we'll discuss how you can send those his way. So from there, take it away, Steve.
Thanks, Sarah. As Sarah mentioned, I'm Steve Metz. I've been a CPA for over 30 years, always in public accounting. It started more as in audit area, and it has become a personal and business side for about the last 20 years. And so we spend a lot of time in my office, where I'm located in Minocqua, working with small business clients and individuals. And I guess I wanted to start today a little bit just, giving my interpretation of the difference between what a CPA can do for you versus a tax professional. Obviously, there's good people in this world. Education has a lot to do with that, but I'm somebody, and most CPAs are dedicated a whole career to public accounting, understanding the tax law, going to seminars, and practicing for decades in many cases. I've known many other CPAs that have been practicing for 40, 50, 60 years, some into their 80s and 90 years of age, believe it or not. And that's not to say that other tax professionals that are not CPAs aren't good professionals and they can't do a good job on your taxes. It's just that they have less experience, and you have to be aware of that. I guess I've always given it the analogy, very simple. If you want to go and have a steak dinner, you're going to go to the finest steakhouse in your community. You're probably not going to go to McDonald's. And yes, you'll get beef in both places, but it's going to be different. So, that's one of the biggest differences is really the background, education, and experience. My particular experience in Minocqua is I have currently about 2,500 tax clients. So we get a lot of practice and repetition with the returns that we do. There's really probably almost nothing I haven't seen in my career. That's not to say we're going to answer every personal question that you may have today. We will try to, speak in generalities and answer, as many questions as we can. But if you have a specific tax situation, I would say, contact your tax advisor or our office, and we'll try to give you more personalized attention. And really, that's what we do in our office. Our focus is dealing with individual problems. There's no cookie cutter. The government tried to give us a tax form that is very generic, lots of schedules, most of which don't apply to most taxpayers, but everybody has a special need and have circumstances in life that dictates, really having a tax professional. So, I guess I wanted to start with that background information. The main thing, obviously we all know that taxes evolve around money. That's stating the obvious. And bracket management is the single focus in our office. If you go to the irs.gov, I happen to have one of my tax guides here today, and I know these numbers because I see them all the time, but depending upon how you file your taxes, be it single, head of household, or married, the tax brackets you should be aware of to know where you fall. Are you in the 10, 12, 22, 24% or higher brackets? Because that will dictate how you make deductions, how you plan your tax life. Because it does require planning. If you just do nothing, it's a math problem, and you can figure it out and file your taxes. But wouldn't it be nice to put yourself in the best possible position and pay the least amount of tax that you're obligated to? And that's really what our job is. I have a saying in my office that paying tax is a measure of success, and that is probably more geared towards the business clients. But I've had many clients over the years that have set a goal of paying tax of $200,000 a year, and that's just a crazy number because that's way more than the average American and people in our communities from Merrill to Tomahawk to Rylander to Minocqua make. But we have plenty of clients that pay that much, and the reason they pay that much is because they're successful in doing what they do. But and believe it or not, they're actually happy to pay that because they know they're contributing to society, but they're providing jobs and they're successful. And so paying tax is the measure of success. So remember that today. Taxable income. Well, before I even get into that, let's just talk about the tax history a little bit. And I don't want to go back all the way to '86. But that's when we had the first big tax reform. President Reagan was at that time. And really, up until recently, really 2018 is when we've had some of the Trump tax changes. There really wasn't much change for several decades. They always are tweaking things from year to year, and administrations change. They have a pet project. They want to do this or that. And those things are pretty easy. But the two biggest tax reforms we had were in 1986 and then again in 2018. Right now, we're in the Build Back Better bill was passed by the House recently. These are some of the Biden administration changes, and it really doesn't matter which side of the political spectrum you're on. It's going to be law one way or the other, and it will change again when a different administration comes in. So from my perspective, it makes no difference to me who the administration is and who's making the rules. My job is to interpret the rules and just help the taxpayer as best I can. But we do have a big bill that was passed by the House in early, they've been working on all fall, and in November, I think it was December 2nd, actually, it was passed in the House, but it's stalled in the Senate. So a lot of what we'll probably talk about today will be what really current law is today, because that's what we have to talk about. There are a lot of changes on the horizon, a lot of speculations. I'm glad that we're 1 year removed from the election, because election years are years of promises, and it takes the Senate and the House years to get through that stuff, and most of it never happens. But for the most part, we want to just talk about what law is and how we can help you, and how you can save on your own taxes, and maybe you can pay only $200,000 a year. And that would be a measure of success. I guess I have several other topics here, but I guess I would like to work on some of the questions that have been already previously submitted. And if there's more questions, please send them in. Those questions will come to us, and Sarah will answer the easy questions, and I'll answer the hard questions. I guess the first question is what is the maximum gift amount for 2022? We've historically had a gift exclusion of $15,000 the last several years. I think it's probably been in play for almost a dozen years. It hasn't changed in a long time. For 2022, the annual gifting exclusion is going to be $16,000 per gift per person, and that would be from the giver could give up to $16,000. Say they have 3 children and a favorite cousin, and other individuals, they can give $16,000 a year. And all that means is there's no tax forms that need to be prepared for that. A lot of times parents will come to us and say, I want to help my child buy their first house. I'm going to give them $50,000. Even the old rules at $15,000 or $16,000 doesn't satisfy that, but it still can be done, because what happens is mom and dad both can give $15,000 to their child in this year, but for next year, $16,000 each. And then the mother and father could also give 15 or 16,000 to the son-in-law or daughter-in-law. So now that's a way that we can move, $64,000, and there's no paperwork. So, as a tax professional, we say, well, let's write 4 checks rather than write 1 check and then have some tax forms to do. It's a misnomer that, the receiver has to pay tax on that gift. The receiver will never, ever pay tax on a gift of cash or property or stock or whatever mom and dad might give them in that example. But the giver has paperwork to do. And there's still, even if, say, there was just mom was alive, father was gone, and 1 child, and mom still wanted to give the 1 child $50,000, it still could happen. And then mom would just have to file a gift tax return. It would produce 0 gift tax. And I always give the big 0. I've got to get my the camera here right, but it would produce 0 tax. It's just paperwork. And that's because the lifetime estate gifting limit is $11,850,000, and most people are well below that in their lifetime and estate planning. So it's just paperwork, but do talk to your tax advisor before you do it. Another easy thing to do is we're approaching the end of the year. We're today, December 20th?
Yep.
And so let's say you wanted to give over the limits and you didn't want to do the paperwork. Some of the advantage would be splitting those gifts between 2021 and 2022. Do, 16,000 or 15,000 to everybody before the end of the year and do 16 January 1st. It counts as 2 different gifts in 2 different tax years. So again, it's not really a big deal. It's more of a formality. But there is sometimes paperwork that has to be done, and you should talk to your tax advisor about that.
So follow up on that then, how that differs then from like a prize that you would have won though, correct? Correct.
A gift of money from it could be a family member, but it could be a complete stranger too. There's a lot of people that when they get older in life want to thank their neighbors and, the paper boy and, people that they're unrelated to, and you can receive a gift. The receiver can receive a gift from anybody. It's not taxable income, because exactly right, Sarah. It's not a prize. It's not a taxable event to the receiver, because it's just that. It's a gift. They gave something of a free will nature, and it's not taxable. It'd be no different than if they gave that money to, say, their favorite charity or a church or something of that nature. Okay. So there's nothing to report on the receiver's end ever. Now, I'm going to just bridge that question a little bit. I don't know if there was a question here in the topics, but in my side is, let's say it was inheritance, and let's say mother passed away and left you, let's make the number $50,000 again, or keep it at $50,000. And let's say it was just a bank CD or money in the checkbook, and that would be the same as a gift. And the only difference between a gift and inheritance is that the giver is either alive or has already passed away. And so in that case, there would be no paperwork again, other than it would be money that would flow through an estate return, but there would be no tax. The government would get 0 tax. And people call it death tax. It's really estate tax, but there would be nothing as long as the estate is worth less than $11,800,000, which is a substantial number. But let's say that I don't want to use the word gift, but let's say mother has no cash, but she gives an IRA. She has an IRA left, and her daughter is the benefactor of the IRA. Now, that is a different situation. Again, for estate tax, it's all fine. It's under the $11 million figure. But what happens different with an IRA is somebody's got to pay tax on that IRA. And it's very different than just a straight gift, because it's a deferred account. And so because of the deferred nature of that, as the daughter draws that out, and there's a whole different set of rules, maybe we'll get a question on that today. I won't go into it right now, but those rules are different, but the daughter would have to pay tax on that as she takes the money out. So it's because of the type of money is received, not the fact that it's inheritance in and of itself. All right. Do you have another question, Sarah?
Nope, that's about it for now.
All right. The next question we had here, what is the maximum income that remains in the lowest brackets? And there are, and I group the 2 lowest brackets together always in my practice. The brackets start at 10%, and then there's a 20%, And then the next jump, in fact, the biggest jump after that is 22%. So there's a 10% increase in that bracket difference change. And for single people and married people, it's different. You know, most of my clients are married, and I think the question was centered around about an $80,000 figure, and that is true. For 2021, a married couple, the number is $81,050, and as long as their taxable income is below that, all that income will be either taxed in the 10 and 12%. None of it will be in the 22 or higher percent brackets. And then, you know, kind of paralleling that, an individual is about half that. It's $3,525. And so, you know, we look at those things all the time. That's one thing that I always like to talk to my clients about is, I led off with that as my second point today, is bracket management. You know, if we have an opportunity not to be paying tax in that 22 or higher bracket, maybe we put some money in an IRA. Maybe we increase our retirement holdings at work. Maybe we use an HSA. Maybe we're itemizing, so we maybe give some more charitable deductions, you know, to church and things. There's ways to move your income out of those higher brackets. And it's also a misnomer that, well, okay, once I hit, say, the 22%, all my previous income is taxed at that higher rate. It isn't, it's graduated. So let's say you had, in the married case, $81,050 is that limit for this coming year, or for 2021. Let's say you had $81,100. It doesn't mean all $81,000 is taxed at the highest bracket. It just means that last $50. And so our goal would be to try and get those last $50. And of course, we're not managing for just $50, but, you know, but maybe they're $10,000 over the limit, and putting some money in an IRA would help. And so those are the types of things that we would like to do with the bracket management. And then, of course, there are a lot of proposed changes. I mentioned before, Build Back Better, the America plan. There are rate changes in there. And this isn't a political statement, but during Biden's campaign, and he's pretty much held through this the whole while, he said that he wasn't going to raise taxes on individuals under $400,000, which largely is everybody that we know. There are, you know, obviously I have clients outside those brackets, and in all of our communities have people, but most people are under $400,000. So really most of the proposed changes that will increase taxes only affect the very wealthy. There are a lot of things in those bills that will benefit the lower people or lower tax brackets, like a lot of people received advanced child tax credits this last year. And, you know, we know from the credit union side, because we see that coming into the bank accounts, it's benefited a lot of those families. In fact, the last payments were December 15th. And that's going to continue at least for one other year, but we'll see. I don't think there'll be advances next year. It's just going to be part of the tax returns. But those are things that are going to help individuals that are on the lower end of the scale, not increasing their taxes, actually reducing their taxes. The next question we have here is, you know, kind of when should we deal with quarterly tax estimates? Generally, most people handle their taxes by paying through withholdings at work. They fill out a W-4 when they start their work. The form changed here a few years ago, and they have taxes withheld. It actually, that form reduced the amount of taxes that were being held, so it reduced a lot of refunds people were getting. But that's how most people handle their taxes. There's a few people, and we see it often in our practice, business owners in particular, don't like to have withholdings. They would rather use tax estimates. We see that happen quite often also with retirees, because retirees don't have a job anymore. They do have IRAs and pensions and 401ks and things of that nature. And in fact, even Social Security, you can have withholdings on all of those, but it's kind of an HR headache for them, because they can't just go downstairs and see their HR director now and say, okay, I'd like to change my withholdings. And it's a nice, easy, friendly conversation in the office. Now they're on the phone, they got to write letters, they got to fill out forms. And so a lot of our clients will actually use tax estimates when they kind of get to those situations. And some augment those two together. They may have some withholdings on some of their retirement or something, and then it's not enough, and then they'll do estimates to complement that. The same rule applies in both cases, though, because a lot of times the follow-up question with tax estimates and withholdings is, how much should I pay in? And generally, the answer is if you're paying as much tax as you owed, not you owed, but that your tax liability was the prior year, you might have got a refund, but say your tax was $5,000 and you had $6,000 paid in, you got a $6,000 or you got a $1,000 refund, but your tax was really $5,000. So as long as you pay in as much tax as the prior year, either through withholdings or with estimates, you'll be protected and you can't be penalized. And that would be a case even if you had a lot more income in the following year. Just a final comment about estimates is estimates actually have specific due dates. For individuals, that is April 15th, June 15th, September 15th, and then January 15th of next year. So you would pay on those particular days. You can't just write one check at the end of the year because the government needs their money on a regular basis. So there are due dates on that. One of the things actually in that new bill is the proposed change, again, because nothing has been signed yet or has cleared the Senate. They're proposing to make those tax estimates every 3.5 months. So it would be April, July, October, and so changing the dates a little bit, because if you look at a calendar, they weren't quite evenly based, but they've been that way for my whole career, so that's 30 years, and I think it was even before that, so they haven't changed that in a long time. But somebody must have finally looked at a calendar and said, let's figure this out. Let's see, another question we have here is tax on inheritance from investments such as a mutual fund. I mentioned a little bit before as we were kind of talking about gifting inheritance, but inheritance is an interesting thing. The general rule is no inheritance is taxable. And the exception to that are really three things. They would be IRAs, other retirement accounts like pensions. Well, most pensions expire on death, but would be like 401ks, 403bs, deferred dollars like IRAs, and U.S. Treasury bonds. None of those get stepped up, and I'll talk about step up in a minute, but so that means as the receiver receives any of those type of proceeds from as an inheritance, it is taxable. And it could be directly from, say, mom to a daughter, or let's say mom had a trust and it went to 10 different people. Some were family members and some were friends. It doesn't matter. There would be K-1s issued. And the same would be true. It's just a math problem then of dividing that amount of taxable income among the number of individuals that are receiving a share. Now, and the reason that those three aren't stepped up is because those were all deferred incomes. The question really was about mutual funds, and we can throw now mutual funds, stock, land, the lot next door, mom's house. We can throw all of that into the same bucket, and all of those assets will get stepped up to fair market value at date of death. So what will happen is if we find this often with older clients where they have old mutual funds or stocks and they don't know what they paid for them. Our advice a lot of times isn't to sell them in their lifetime because they don't know what the basis is, so it'd be hard to calculate the tax. Either hold them till you die, they'll be stepped to market value, or give them to charities. But with that step up in basis, that means that, say, mom's house was, she'd lived in it 50 years, which could be true. She bought it 50 years ago and paid $10,000. It's on the river here in Merrill, and it's worth $500,000 now. You'd think there'd be a lot of tax owed, but ironically, all the tax goes away. It gets stepped up to $500,000 at her date of death, and so no one's going to pay tax on that, be it the one daughter receiving all of it or 10 family members, doesn't matter. That happens with almost all of those assets. It's interesting that in the recent tax bills, they were talking about removing some of that step up in basis, not hurting so much the smaller net worth individuals. They were talking about having $1 million step up allowed, but what they were looking at was the much wealthier people, that have, millions or hundreds of millions or billions of dollars, because they got the same treatment. Now, and from the step up standpoint, so they were able to avoid income tax, and they still had estate tax problems in many cases, but they were able to avoid income tax. But that hasn't passed, and so right now all of those provisions are really speculative, and so right now, if nobody plans their death, but let's say you had a death in the last week or month, and I talked to a client today, their mother passed away on last Friday, and so everything will adjust to fair market value, and that's just what the laws are today, and that's all we have to pay attention to. We have another question here. Someone is newly retired or will be retiring in 2022. What should they be aware of for tax purposes? They mentioned Social Security, SSI, money markets, and those sort of things. The first thing I ask every retiree, and I have to ask the ladies the same question, is, what's your date of birth? You're never supposed to ask a lady how old she is, but that is really important in my line of work because we have a lot of early retirees, be it 50 years old, 55, and as we know, full Social Security benefits for most people, I know for me it's I think about 67. Sarah's younger, so it's probably older. She probably hasn't even researched that number yet, but I'm sure it's older than 67. And they do talk about raising full retirement benefits to age 70. But so we need to know the age of the individual because we have a unique planning opportunity in a window from the date they retire until full retirement age, because we can elect how we're going to tax their income. What we don't want to have happen is zero tax returns. Particularly, let's say they have, $500,000 in an IRA. They don't have to take any of that money out. Maybe they have enough income, they'll do a side job. And we don't want to have zero tax returns until age 72, which is the year they have to start taking money out of the IRA. Because if they have to start taking money out of the IRA, it's maybe doubled in size by then. There's a calculation for that. There's a life expectancy calculation. But maybe they got to pull 40,000 or 50,000 out. They don't really want it, but they have to. Now, all of a sudden, they went from zero returns. Remember we talked about tax brackets? That might now push them into a 22, a 24, or higher tax bracket. A lot of times when you retire early, if you're married, you hopefully have the benefit of having your spouse with you. But once you get into your 70s or older, you could lose your spouse, and now all of a sudden you go from a married return when you were smaller, had smaller income and were retired, you could have pulled some more money out, not necessarily spending it, but getting it out of those taxed accounts and paying little or no tax. And once you're 72 and you lost a spouse, now we got the smaller brackets again. And so now we're going to pay a lot more tax. It looks good on paper initially to pay no tax for 5 or 10 years of that early retirement time frame, but the problem is you're probably going to pay a lot more tax in your lifetime. And so those are the things that we work with a lot of our early retirees and knowing their age and their plans, how they want to spend their money. And sometimes it's looking at their assets. I happen to live in Minocqua, not too far from Merrill. We have a lot of second homes up there, and a lot of these people are on these properties only as vacation properties now, and they live in Madison or Indiana or wherever, and they're going to sell those homes and they're going to move here. And so now we got to plan how we're going to divest of these things, because we know once they get older, say in their 70s and 80s, they're going to use them. They're going to use those properties hard for the next 5 or 10, 15 years. But when they get older, they're probably going to move back to family again. So we got to think about this years ahead of time to anticipate how we're going to do this and what are going to be the tax consequences. So hopefully, retirement is really it's a fun time for the individual. It's not hopefully because you hate your job, but certainly from a planning standpoint, from a tax perspective, there's a lot that can be done. And really, it's an interesting time to talk to a tax professional because there's a lot of opportunity there. Also in that question, there was some question about SSI. My guess is SSI is Social Security Disability. This person must be under 62, which is early retirement age for early Social Security. And SSI is taxed just like Social Security. There are earning limits, though, with that. So, there's different rules with SSI than, say, Social Security, although Social Security has its own rules as well. But that's really an SSI question, and, that person should certainly talk to a tax professional about that. Let's bridge that. I'm assuming we got more questions, too, and I got some more topics, but let's talk about Social Security for a minute. A lot of people ask when should they start drawing Social Security? Sarah's way too young, but and I'm too young for that matter too. But most people have the opportunity, assuming there's no disabilities, to start drawing at age 62. Full retirement age for those that are much older and already drawing is irrelevant, but for those that haven't started drawing, the full retirement I think is 68 years and like 10 months, just short of 67 years. So that's when your Social Security benefits are calculated. And certainly if you're in that window, I'm going to say at 62 or older and you haven't started drawing, you certainly should look at Social Security Department. It's probably, the website's probably socialsecurity.gov, and you should get your benefit review and making sure a couple things there. One, that you qualify for Medicare, which means you've worked at least 40 quarters or 10 years in your lifetime. Most people have. Sometimes we have some older generation women that haven't because they were caregivers and things, and so we have some things to deal with there, but most of the generation now, that's not an issue. You should also make sure that you have wages posted in every year because it'll list your wage history, and you should look and make sure that all of your years have some wages in there. Now, if you had a bunch of part-time jobs, you might not know really how much you made, but if you see a bunch of zeros, that might mean that your W-2s aren't recorded. One thing I always make sure I ask the ladies is when they got married, if they changed their name or not, because their Social Security number didn't change, but you should make sure that your Social Security benefits tracked with you with your name change. So see, I got a from Sarah on that one. But it's really not a big problem, but it's easier to fix those things when you're younger and you may have the documents to support it rather than being, 60 years old and you've been married 40 years and you aren't going to have 40-year-old records. But I guess my point is with Social Security, there's a lot of questions with Social Security. I know the local Social Security departments are wonderful, really, with call-ins, and they do make appointments now, even with some of the COVID things that have happened. But they will be very good with clients and helping you calculate what's your best benefit. What I tell clients all the time is there's no right or wrong answer when to collect Social Security. It's really a personal choice. And even in a couple situation, it's not the couple's decision. It's really the individual's decision. Because let's say father is, say they're the same age and they're both 62, but father has had terrible health. All his family members have died of, heart attacks or, whatever at a young age, and say he's got poor health himself. The best advice might be for him to get Social Security as early as he can, get as much as he can, and that may help the family. And I'll assume on the mother's side, the wife's side, that she has great health. Her mother is 98 years old. All her aunts are still living. Her sisters are all very healthy. She might want to wait on Social Security. And the other reason for that is financial, because at age 60, assume 67 is your early or your full retirement age. Each year you take Social Security early, you agree to take an 8% less benefit each year. So if you take it, 4 years early, you're going to reduce your Social Security benefit by 32%. It's a substantial adjustment. Inversely, if you wait past 67 and so you have good health on your side, your pool will actually increase by 10% per year up till age 70. It doesn't grow past age 70. So in our case, and we live in a good community with great healthcare facilities and fortunately good genes for our clients. Most of our clients don't even start drawing Social Security until age 70. They're entitled at 62, but they're looking at their health. They're doing financial calculations with us to determine when that might be best for them. And again, we get situations where the couple's health, his health maybe is not good, hers is very good, so maybe he starts early and she waits. And so it's an individual decision based on your own health. It's really not a couple's issue. It's really a health issue. Something else about Social Security, and again, these are really not tax matters, but we talk about them every day in our office, is let's say husband and wife it doesn't matter really so much their age, but look at their retirement benefits. That's why I always have my people that are thinking about retiring and going on Social Security get their Social Security benefit sheet from the Social Security Department office, because let's say the Mr.'s benefit would calculate out to $2,000 a month, and the mother didn't work as much. She was the care provider and raised the children, and just had part-time jobs around their activities and things, and so she didn't make as much. And let's say her benefit was going to be $600 a month. A lot of couples don't realize that when the missus could, instead of her receiving her $600 a month, she can receive half of the husband's benefit. His benefit is already what it is. He's going to get $2,000 a month, but she could get an increase, actually get $1,000 a month benefit and not be locked in at her $600. So those are just discussions that you're not going to get, you know, when you do your taxes on TurboTax or something like that. It's not going to give you that. It will prepare your tax forms for the year, but that's not going to give you the consulting help you need. And really a CPA or someone, a financial advisor could be that person also, should direct you to those type of sources and help you do those calculations.
So switching gears to maybe more of a younger demographic, someone such as myself having a kid in the last, year, what's that going to mean for my taxes?
Well,
anything?
Yes, lots of things. That's a loaded question. One of the things, that most people should have, if the child was born this year, they didn't qualify. Well, they will qualify when they file their taxes, but if the child was born this year, they didn't get the advanced child tax credit.
Right.
And so you will get it on your tax return. And so if the child is under age 6, I think it's $3,600 a child. That replaced the old $2,000 child credit. And then if the child's older, up to age 17, it's $3,000 a child. But let's say, you had mom and dad had 2 kids on their last tax return, no new children. They were qualifying for an advanced child tax credit, started in July. I mentioned earlier today that the last of the 6 payments should have been received by December 15th. And really what those payments represented was half of the credit that they'll get on their next tax return, but it was the government putting the money in your pocket sooner. Okay. Now, I don't know in Sarah's case, but say your child was born this year, you didn't get any advanced credits because the government doesn't have a tax form that your child was a dependent yet. So then that parent or those parents would get a full $3,600 tax credit on their next tax return. So that's one of the obvious benefits that affect the dollars and cents right away. You're certainly not thinking about college yet from an expense standpoint, but you should be.
No, we are.
Relative to 529 accounts, and that's a whole nother set of topics. But parents, grandparents, the rich uncle, anybody can create a 529 for a child. The 529 account is an account that's used. It's used to grow. It's like an IRA, and the parent or whoever funds it can fund it up to $3,050, $3,100, I think is the limit this year. Okay. If you overfund it, that's fine. The extra just carries into a later year. And that would be with the Tomorrow Scholars or the EdVest accounts. But say you're going to use Vanguard, American Funds, or Fidelity, or any of the other brokerage firms, you can create a 529. The limit of putting money in, we talked about this, I think it was one of the first questions, was the gifting limits. You can put up to 5 times the annual gifting amount into it. So let's say you have a child this year and you want to put 5 times $15,000 into a college fund, you could do that. And that account will grow tax-free really forever. And you're naming your child as the beneficiary, and what will happen is it'll grow tax-free, and if the money is used for college expenses, books, tuition, any university expense that's required, and it could be a technical school. I shouldn't say just university. It doesn't have to be a 4-year school. It could be an accredited, 2-year program, 1-year program. Those dollars, as they're spent for those expenses, are tax-free. The parent and the grandparent, whoever puts money in those 529s, other than the EdVest and Tomorrow Scholar, gets no tax benefit today, but it does grow tax-free. And what we see a lot of times, and let's say we're having a market adjustment on Friday and a little bit today, it's got a long way to go, but we have a lot of clients that are on a watch list that if, let's say the stock market is in the 35,000 range right now, say it plunges to 20,000, we have a lot of clients that are going to be putting money in 529 accounts. Why is that? It's because, buy low, sell high theory, but you've already realized your losses in your 401ks and things. If you didn't move anything, that's all fine. But let's say you really believe that the stock market will rebound, which it will. What better time to put it in when you know it might double up, and we can use the COVID year of 2020 as a great example. Stock market dropped 30% in a month. It rebounded within 3 months. You could add a 30% growth in a 529 account. Nobody will ever pay tax on that as long as money's used for college. So it's a good strategy. And let's say you just have one child today, and you're going to have more children in the future. That account can be split into multiple beneficiaries at a later point, and so it'll just serve the same purpose for all your children. Okay. And we see that often. Then let's keep talking about children benefits. There's, of course, child care. Is that expensive or not? Unless you have a good arrangement, it's super expensive. The benefit in the past was to either use your dependent child care programs through work. It was a $5,000 limit. Or you could get a 20% of the cost of $600 per child. It wasn't a maximum credit of $600 per child. It wasn't a great credit when child care could cost $20,000 a year. And you go to a big community like San Francisco or LA or New York, it's $30,000, $40,000 a year. There are some huge proposed changes in the child care bills that are not passed at this point, raising those dependent deductions on your work schedules up to $15,000, I think the limit is, and then raising those other credit calculations substantially as well. So there's a lot more to come. We're waiting for the new bills to pass, but certainly that's something to consider. And then, of course, let's go 18 years down the road and we're at college age. We got that 529 to use. Let's say we didn't fund it as good as we maybe should have. Grandma and grandpa didn't put in as much as we thought they were going to put in. And we know we're going to have some out-of-pocket costs. So what we want to balance then is how we use that 529. We don't want to use it all in the first year or second year, say we only got 2 or 3 years of money there. But let's use some each year, and there's some really nice college credits available for the parents.
We did have a chat come in. Because of COVID, are you taking face-to-face appointments yet at our Minocqua office? And if not, do you do phone meetings to answer any questions that they may have?
Yeah, I can speak to our office. Other accountants, I'm not sure what they're doing, but we do take face-to-face meetings every day. Most everybody's been vaccinated. You still, got to take care of yourself. We have a lot of clients that want to wear masks yet, and that's fine. We ask clients as well if they would like us to wear a mask while we're in those meetings, and we do those things. So we do face-to-face meetings. Historically, we've met probably with 80 or more % of our clients every tax season. COVID was a huge change for us. We never closed our office, but obviously everything dropped off. If we saw 20% of our clients 2 years ago, this past year it was a lot better, but we miss that client interaction because there's a lot that can be said in a meeting that's hard to text, and we do a lot of phone conversations too because we have a lot of clients that are either snowbirds or they actually live somewhere else permanently. So that can be done too. Okay,
great question. Any other questions? Feel free to chat them in. Otherwise, what else do you got for us, Steve?
Well, let's see here. Roth IRAs and regular IRAs, we've kind of talked about that. Again, this is going to go back to bracket management. If your taxes are in that 24% or higher bracket, I don't care your age. If you're young like Sarah or older like me, or let's say you're 65 already, if your income is in a lower bracket, you're going to want to do the Roth IRA. We're not looking for that tax deduction. and we're willing to pay the 12% tax today to not pay any tax on it in the future. If we're in a higher bracket, we want to save inversely the tax. We want to save that 22%. And I should mention that the state has a tax as well, so that only gets higher. So you're wanting to do regular IRAs and like your 401ks, you want to do the deductible side if you know you're going to be in the higher bracket. And so do pay attention to your brackets. Social Security, we kind of talked about that, but I will just mention taxability. A lot of seniors are surprised to find that Social Security can be taxed. There's a line on your form, I didn't bring the form with me, I think it's 13A if I'm not mistaken, but your gross Social Security is included in your tax return. How much is taxable is based on the sum of the other parts. For most clients, as a married couple, it's not taxable. You have to be over about $45,000 of income from other sources to have that taxable. But for the most part, you got to be aware that it is taxable. So let's say you had drawn some extra money out of your IRA in a year to go on a trip with the family or buy a car, help your daughter buy a home or something. And if you didn't plan that right, you could have up to 85% of your Social Security being taxed, when it could have been avoided by controlling how you drew out some of that money. So you do want to talk to a tax professional about that. It is important. Something we haven't talked about at all yet was capital gains. Capital gains and qualified dividends. That was one of the biggest changes. Well, we've had capital gains rates really since the tax changes of 1986, except for a few years during the Clinton administration that got rid of capital gains tax rates. They kept the structure of the income, but they changed the rates to the highest ordinary rates. That's one of the things that's actually proposed right now for the very highest wage earners and income producers like Warren Buffett and Bill Gates and people like that, that their capital gains rates are going to be at the ordinary rate or higher. For most people, the tax rate is going to be 15% at most. And so qualified dividends would also fall into that. That is a lot to explain, so we won't talk about that today. But capital gains would be you sell the lot next door, or you have stock in a brokerage account that you sell. Those things have capital gains, and so it would have a maximum rate for most individuals or most married couples if their income's under $450,000. If say your income's over that, it could actually get to 20%, but still that's a very cheap tax on a significant income. I know in our office today, we were working on a couple that sold some Iowa farmland and their gain was like $1 million. So they had, actually there's some 0% brackets, some 15% and some 20%. So they're going to get a little bit in each bracket just because their gain was so large. But that's just how it works out. So capital gains are treated specially for tax rate purposes. We did talk about taxes on gifts and inheritance. Basically, generally there is no tax, and we don't have to go into that anymore. We did have a COVID, for open at the office COVID question, but there are some COVID tax issues, more geared towards businesses, but there was, I get my terminology right now, Sarah probably correct me on this, but if you had individual employees that had COVID or COVID-related issues, the employer could actually get credits for the amount of pay that they paid that individual while they were off work. So it didn't cost the employer it's like family medical leave, but it was COVID Leave Act, I think, or something like that. And that's really has nothing to do with individuals. If you were the receiver of that money as an individual, it's on your W-2 just like you worked because you got paid for not being there. This is all on the employer side, and we do a lot of business clients, so we see that on the business side. Some of the other things that factor into other deductions like that would be health insurance, benefits, unemployment, PPP, which is the payroll protection. These are all business things. There's employer retention credit, which has to do with businesses that weren't so successful during the COVID period. Mostly impacted were all of us were impacted some way, but restaurants, those in the entertainment industry, theaters, amusement type things, they were certainly damaged more than the rest of us. In our area, we have a lot of construction. We do have a lot of restaurants. Some of my restaurants had their best years ever during COVID. They just had to adjust and do everything outside. Largely COVID was good for business. But that's us, and I'll include Merrill, Tomahawk, Rhineland. We're in the Northwoods, where everybody wants to be anyway. Those that are coming from Chicago, they were using their second homes, or Madison, and so we had a lot of people in our communities. College credits, we didn't talk about that at all. We just kind of alluded to it. There are college credits, and I believe they're revamping that again a little bit. If the parents, and the parents are the ones that are eligible for these credits. A lot of times grandparents want to pay for college, or say the rich uncle. They can't qualify for these credits because they need to have that child on their return as a dependent. And the parents there's all sorts of tie-breaking tests and all those things, but parents will win every time because it's their child, and they should. And so what will happen a lot of times is the grandparents may give the money to their child to help their grandchild go to college. And so the college credits are up to $2,500 per child per year, and it's up to 4 years. And then after that, there's a lifetime opportunity credit. But again, planning opportunities with your tax professionals, how to use those 529 accounts versus using money out of your pocket to help pay for college.
So it's important to meet with both, from the sounds of it, maybe with a tax professional and maybe a retirement or an investment professional when it comes to that, or can the tax professional help with that investment portion as well, kind of thing? Because when you're planning for your kids going to school, you more than likely think investments and maybe not tax.
Correct. What I tell my clients is call me first. Okay. And the reason I say that is we're independent. We have nothing to sell you other than advice. We have no mutual funds, no stocks, no insurance products, nothing. I know other accounting firms have those things to sell. Then I say buyer beware, because they might recommend what they have to sell. In my case, I have nothing to sell, so I can. My first question is, are you working with a financial advisor? You say, yeah, I'm working with, Julie at, Smith Barney or something. And I can work with anybody and work through you, but you want to use the relationships you have, or you may say, well, the person I have, I'm not sure they are helping me, and we can get a second opinion. But, just talking to the financial advisor, they're going to invest money. They're not really looking for your tax strategy at all. Certainly most of the things we talked about today, they wouldn't even know what to do. In fact, many of my clients are financial advisors. And that's because they're good at financial investments, which stocks to buy, sell, and that sort of stuff. Tax is a different animal. Yeah. And so, I think you start with your tax professional, because, most tax professionals will not have anything else to sell.
Okay.
The last thing I had on my list here, and if we get some more chat questions, that would be fine, is health insurance and HSA accounts, health savings accounts. Sometimes MSAs, if they're employer provided. If you have those options available, you should use them. A lot of clients only take the minimum or take the employer dollars. We're all going to have health expenses later in life. It's like saving for retirement. I know an 18-year-old doesn't like to think about retirement, but if you put money in the HSA, it's all tax-free. You can use it on whatever. It's different than the old flex accounts where you had to use it or lose it. So now this money can grow in that account, and it can be used in a different year. It can accumulate over for years if you want, and it's just a benefit. That's all I have for today.
Yeah, well, we have about 5 minutes left of our allotted time if anyone does have any last-minute questions. But before, we end, I do have a few words, but I'll give it here a second of me rambling maybe. But I'm glad this is recorded. It'll definitely be helpful to relay to my husband to say, here we go, honey, here's some great advice for our future. So I appreciate that, but with that, I want to make sure I share your contact information for everyone here. So let's see, there we go, there you are. All right, well, again, thank you all for attending today's Northwoods Financial Series session. As I mentioned, this is our final session of the year. If you have some ideas that you'd like us to bring as topics for 2022, we can certainly look into those. Feel free to email marketing@parkcitycu.org, and we can take those into consideration. And stay tuned into the Park City website and our social media details for any upcoming educational pieces in the new year. So again, here is how you can get in contact with Steve at his office. Feel free to call him. On their website, they do have a contact form as well that you can send general questions his way as well. I can't see any chats coming in, but feel free. Otherwise, thank you again, Steve, for attending today.
Well, thanks, Sarah, and thanks to Park City for allowing me the hour to share some things. I'm passionate about what I do, like Park City's passionate about dealing with the members here, and there's a lot that we can talk about. So I guess we have to do one more question here. We
do have. Is it a good idea to contribute to HSA after tax to make medical payments?
Yes. If, let's say you don't max out your HSA through work because, we only have, some people may only have one paycheck yet this year, you can contribute to your health savings account up till April 15th of next year, much like your IRA. You might not be able to contribute into the same account that your employer has the account with. Sometimes it's and here it's probably with Park City Credit Union, I'm guessing, because you have Park City Credit Union, HSA. Mm-hmm. So you should be able to put right in that account. But sometimes they're with, a different bank in a different part of the country. Well, it's hard to make a deposit there, but you can open an account at your local bank. You just have a limit as to how much you can put into the HSA each year. One thing I remind clients about HSAs is make sure you have HSA eligible insurance. I find some clients, they want to make HSA contributions and they don't even have health insurance. You can't do that, and the IRS will catch you on that eventually. So you obviously should use HSAs. If you participate with your employer, what happens is you save also the payroll tax. So make sure you try to put as much in during the year as you can.
And then we have a couple people that are. I guess I'm asking if there is a tax benefit to do it that way.
Yes, there is, because you can deduct the amount of HSA contribution. If you're doing it through work, what's going to happen is your W-2 is going to be smaller, so you're going to have less taxable income on your W-2. But let's say you don't max, or you don't have it at work at all, and you have an HSA with private insurance like I do, because I have group insurance, but I can't participate in my group insurance at work. So I get a HSA tax deduction on Schedule 1 of my tax return for as much as I put into my HSA account, up to the limit. So there is a tax benefit to doing it, absolutely.
Awesome. We have a bunch of people saying that they will be setting up a meeting with you soon. It was very helpful. Thank you. Thank you for your time. So I think if that's it, everyone, you know how to get a hold of him now. So hopefully if you have any questions that pop up during your midnight summers, you know how to get a hold of him. So with that, thank you again, Steve.
Thanks.